Hi everyone, Lukasz Kalwak here from Franklin Templeton Institute. Markets never sleep and neither do the opportunities they create. So let's dive into what's been moving the markets lately and what it all means for your portfolio. We've just wrapped up the third quarter and it's been a strong one for US equities. Even though we saw a bit of rotational correction along the way, at the broader market level, the indices only briefly tested the short-term upward trend. That's actually quite remarkable, because historically August and September are among the weakest months for the market, and the third quarter, on average, tends to be the softest periods of the year. And yet, this time was different. The S&P 500 rose 3.5% in September alone, its best September performance in 15 years. Even more impressively, the index has now posted gains for 5 consecutive months, adding nearly 8% over the full quarter. And here is the most striking part. In this third quarter, the one that's usually the weakest, the S&P 500 hit 23 new all-time highs. As you can see on the chart, those 23 record highs are the best result since 1998, when the market reached 25 new records in a single quarter. But if we look at third quarters only, this was actually the best performance since 1929. Pretty remarkable. So perhaps it's not a big surprise that recently the stock market hit a bit of a speed bump. US markets turned lower after President Trump raised the possibility of new tariffs on China, a move that reintroduces the risk of renewed US-China trade tensions into investors' calculations. That said, we don't expect a return to the broad-based tariff volatility that we saw earlier this year. In our view, investors shouldn't shy away from this pullback. First, this correction was widely expected as the market was very overbought, which we widely discussed with our clients. Second, let's remember that stock market rewards patience. And the market appears to be entering a consolidation phase as we just celebrated the third anniversary of this bull market earlier this month. But make no mistake, this is still a bull market, and periods of consolidation, roughly 6 months after a major bottom, are actually quite normal. If you look at the chart, you'll see that after past declines in 1998, 2009 and 2020, the subsequent recoveries were strong, persistent, and every dip along the way was ultimately bought into by investors expecting further advances. The black line illustrates the current behavior of the S&P 500, which continues to track those historical recoveries quite closely. Lastly, let's switch gears for a moment and take a broader, more holistic look at what's really driving the market. Every stock market at its core is simply the result of the balance between buyers and sellers. If you look at the chart, you'll see that households directly own about 40% of the US equity market. That makes them a crucial source of both demand and liquidity. And according to various estimates, households are expected to remain the largest source of equity demand next year, supported by solid economic growth, a still stimulative fiscal backdrop, and lower interest rates that continue to strengthen consumer balance sheets. Those lower rates may also trigger a rotation out of money market funds, and some of this ample cash on the sidelines could soon be redeployed into equities, further supporting overall market liquidity and in turn demand for US stocks. So while market sentiment can shift from week to week, the underlying flow dynamics still look healthy. As always, if you have questions or want to discuss how these trends might affect your portfolio, don't hesitate to reach out. We're here to help. Trade well. Cheers.